Hi all, it's 5th October 2021 today. I'm going to touch on Hong Kong markets review today so far. Well, going to happen for the potential offer for Evergrande and tech stocks in US are the growth stocks at risk right now? Well, before I proceed, appreciate a like for this video and do subscribe to my YouTube channel to be kept updated. As I always say, preparation and knowledge are the best way to prepare one's portfolio. In the art of war, there are different types of ground. One is the live ground, the other one is the desperate ground. So we have to avoid desperate ground if we want to do well for our portfolio. What I wrote this morning on various platforms, right now we are assessing the risk reward for Hong Kong equities. At this current price level, there might be a 10% potential drop in the broad markets. But of course, with this, we also have to look at the beta of individual stocks. But if this 10% did not happen because we are at a critical price point, what's the potential outside? Another 20% outside? So the risk reward isn't that fantastic. The next level of thinking is, will individual stocks present better opportunity? Of course, that is because individual stocks tend to move in a greater magnitude and degree compared to broad markets. What happened for Hang Seng Tech? Hang Seng Tech Index this morning is at a low of 5,824 points, and right now around 1:42 p.m. it's trading around 5,900. It's already way below various support levels that I touched on in the past of 6,300, 6,100, and is 3 percentage points below. So another leg down of 10% is definitely possible because of the short sellers wanting to push it down. The question is, can you take the 10% hit on individual stocks which may be even bigger? That's a question to ask if you enter now. For the futures movement, down S&P, Nasdaq is mixed picture with most nearly flat or slightly down, and Nasdaq 100 is slightly above my critical support level of 14,450 points, and S&P is still around 2 percentage point above the support level. Not all is lost, but growth is always weighing on investors' mind, and financial media has been trying to say, hey, stay up growth, rates are going higher. But to me, I still prefer my growth stock. Reason being because even if inflation goes up, growth stock in terms of revenue, in terms of profit numbers, will outrun the rate increase. But that's why, in terms of my choice, I will choose companies that are already in profit situation and showing that they can easily scale up their profit level to the next level. A quick look at my Hong Kong watch list, one of my watch lists, you'll see that various stocks are at different price level. The surprising part is Xiaomi this morning touched a low of below 20 Hong Kong dollars. That's a very strong support, and yet it touched below. But towards as the day developed, it's trading right now at around 20.85, slightly up 1 percentage point. And Kuaishou Tech is struggling today to hold on to 80 Hong Kong dollars. It doesn't look good. Later, I will touch on its price performance relative to Bilibili, which is already touching 52 weeks low at today's low of 471, but it retraced back to around 482 points. NetEase, the US share, is struggling and it's around 5% above its August low. So we play a catch up back to test its August low. That's something to watch out. I wouldn't touch NetEase right now. Alibaba, stay out for me because it's the one leading the downtrend, and if anything, it will be the last to recover. That's my take. Tencent is still doing better compared to Alibaba, despite it being Chinese big tech. It's still above 10% from its August low, whereas Alibaba is already below its August low. There's enough negative global financial news that is trying to freak out the market. Stock market sell off from US to global markets. Facebook whistleblower, which last night when she said out, happens that Facebook came down over 4%. Nvidia and PayPal is also coming down by more than 4% last night. So you see the big tech stocks enter correction territory as market tumble from Wall Street Journal. And Asian market Straits Times Index down close to 1%. to 3,063. Nikkei is down over 2%, and Hang Seng Index slightly flat. Tencent, I said earlier, it's doing well, but if it tests its August low, it will go to as low as 411. A 10% buffer right now. Is one going to take the risk? I'm not saying that it won't touch 411, but if people who are contemplating between Alibaba and Tencent, my choice is as simple as that, Tencent. But I also wouldn't touch Tencent right now because to me, there are other better Chinese tech stock with a better risk reward. I do hope that Tencent can find a strong base right now. With it finding a strong base, it can then also let the rally back and bring all the other tech stocks like Kuaishou Tech, ZA Online, all to recover. One to have to note is high volatility stock, definitely for Chinese tech stock, the Hong Kong ones. Kuaishou Tech has did more than Bilibili in the last 3 months. Kuaishou Tech is in the red line and Bilibili in the blue line, and Bilibili is down around 46%, whereas Kuaishou is already down 56% at current price level of around 80 Hong Kong dollar. Will Bilibili catch up in terms of the fall by another 10%? We should see it down to around 440 Hong Kong dollar. I have no idea. Or can Kuaishou Tech catch back out in terms of the fall that is not so much, going back out to around 88 Hong Kong dollars? So we should reach. It can cut both way right now. So with people without any allocation in Chinese tech stocks, you may consider to start to think whether is it a worthwhile risk reward level right now. I wouldn't say anything much, but do think through the risk reward and then make an assessment whether your risk profile and your portfolio allocation to Chinese equities in comparison to US equities and Singapore equities, how are they allocated, and can they create a balancing effect? Think through. So even the pharmaceutical stocks like Torrentan and Guangzhou Baiyunshan, which I mentioned before, are not spared. In fact, over the last 3 months, it's now around 20%. You see the red line on top in the chart. It's now close to 20% for both stocks. And Hang Seng Spot is down from 28,000 all the way to 24,000 points, which is also around 20%. So all in all, this stock is quite beta neutral and move quite in sync with the broad market. Whether to allocate or not to allocate is also a market call in terms of broad market view. This is the Xiaomi chart, and to me, Xiaomi it already came down 45% below all-time peak of around 35 Hong Kong dollars, and right now around 20.8, 20.9. It's not an easy call for people who really have positions. Do you want to add or do you want not add? Even if add, who for people like me who already have decent positions, small position allocation into it as additional share may be a better strategy than putting another big portion, because to me it's a critical crossroad. So you can be easily out back 30-40%, or you can come down another 10-20% to around $15 to $16. So watch out for it. People without any equity allocation in Chinese tech stocks can start thinking through whether Xiaomi is worthwhile and a good tech stock with solid hardware business, and include it as part of your portfolio. This is something very interesting to think through. As always, this should not be construed as any investment or trading advice. Do follow me on YouTube so that you can be kept updated on my educational videos on portfolio allocation and position sizing, as well as individual stock analysis and broad market review. Thank you.